please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Welcome back. Well, let's get talking about the technicals of the market. We have the Bank Nifty, which is down 1%, and the mid-cap index also, which is closing in down around 0.8%, along with the Nifty and the Sensex as well. Ashwani Gujral is with us now. Ashwani, tell us, what are you strategizing? Advanced decline ratio is now turned on the declining side. Bank Nifty at the low point, Rupee also at the low point.
See, last 2-3 sessions, the Nifty kind of found support at lower levels, but that appears to be just a pause. The way Rupee is having a huge trend day, I think in the afternoon session possibly both Nifty and Bank Nifty could also accelerate on the downside, because at 77.50 crude and Rupee weakening 50 paise a day, you don't know what kind of impact that's going to have. But what is clear from the morning's action is that the market is now trying to pull away on the downside. So that way, right now you can get short on Nifty and Bank Nifty, and also on Nifty earlier there were white knights like Reliance or IT, etc. Now that's not happening, and Nifty is kind of catching up with the Bank Nifty. So that will probably increase momentum of this move. So having said that, IndusInd Bank remains a sell with a stop of 1850, target of 1800. Kotak is a sell with a stop of 1230, target of 1190. And HCL Tech is a buy with a stop of 1075, target of 1140.
Ashwani, so I mean, even on the Nifty, is there a trade here? At this point, 11,508 on the spot.
See, we are sitting at levels where Nifty found support last week. So it's fairly precariously poised. Rupee is again declining. So everything is lining up for another fall. And last week was the first week of fall. So it's not like we are very, very oversold, etc. So my sense is that sooner or later, as the Rupee again picks up on the downside, you will see these levels go broadly 11,500 and this 27, 330, 350. So right now still barely hanging on. My sense is they should finally break.
Okay, let's get in one quick query for you from Twitter, Ashwani. I'm sure a lot of investors have stock-specific questions now. Sandeep has 10 shares of Maruti. He's bought it at 9,130. Wants to know whether to hold or to sell.
Well, since you are getting declines, it's worthwhile trying to add, 5 or 10 shares around 8,500 if we get there. Once you do that and your, average around 87, 88, then, getting back to a long-term target of about 10,000 seems likely. But he should, people who have these blue chips should use declines to add.
% change on the dollar rupee, 72.45 is where we are trading at. And lots of opinion on what the rupee needs at this point in terms of prescription for some stabilization. Stock markets, of course, also following the rupee cues. It's very clear. I mean, the rupee is the head, the market, the stock market is the tail. Even standalone stock market indicators aren't exactly flashing all green. We just highlighted what's happening with the local flows, which mutual funds have been getting. It's been a big source of liquidity, and that is starting to go down pretty dramatically as well. It's down 40% in August over July. Mr. U.R. Bhatt is with us here in our studios. He's director with Dalton Capital Advisors. Mr. Bhatt, thanks very much. Good to have you here. 1% change there on the dollar rupee. How are you looking at this, and what's your sense?
Well, I think, before this slide started, I think most economists have agreed that on a real effective exchange rate basis, the rupee should be somewhere between 70 to 73. So it has reached that. So I think exporters, whatever problem they had earlier, I think this exchange rate more or less addresses that. And so therefore, I expect that there will be some confidence at these levels, and probably RBI will also play its part and ensure that it doesn't slide too much from here, unless, of course, oil prices go up dramatically higher from here.
Does this, Mr. Bhatt, remind you of what happened in 2013? Was there much more panic at that point in time in terms of, say, the rupee depreciation, the macro concerns, and the RBI going into this whole tailspin of hiking rates? That kind of panic doesn't exist now. There's a clear difference between then and now.
Yes, absolutely, because we're very comfortable in terms of forex reserves, and the domestic economy is doing very well, and tax collections have been good. The fiscal deficit is under reasonable control. So I don't think there's so much of an issue as it used to be earlier. And I think there was a case, because we were not doing so very well on the export front, there was a case for rupee to get depreciated, and probably RBI just looked the other way when it came down. And at this stage, I think they will probably signal the market that thus far and no further.
And signaling will work, you think?
I think it does work, because finally, if you really see, the FDI flows have been reasonably all right, except that some FII flows have been negative for some time now, but not dramatically negative. In fact, if you really see, most of the outflows have been on the debt front. Equity has been somewhat marginal. So debt front, I think the matter has, most of the flows have already occurred. I don't think there will be further huge outflows from the debt from the debt market. And so therefore, I think there should be some sort of stability there. And remittances have been quite robust. So I think all these things will ensure that the market will stabilize around these levels.
There's no fear that the growth momentum that we are seeing is going to get disrupted, right? Because there are expectations RBI is probably going to hike in October, and maybe we don't know how the rupee is going to go. We don't know where Brent is going to settle. Based on that sort of scenario, there's a possibility that the kind of momentum that we're seeing in terms of growth could probably derail a little bit. Are you worried about that?
No, I think the growth momentum has been reasonably good. If you really see, with a good monsoon, I think even agriculture might actually contribute a bit for growth this year. So I don't think there's too much of an issue on growth. On domestic factors, I think things are under reasonable control. It's only the external factors, export, and then you have oil prices, you have issues elsewhere in the world. I think that is what is affecting sentiment. But I think, with the 13% depreciation in this calendar year, I think there has to be a stop somewhere.
But there are many companies which are benefiting from this, export companies, and you can see it in the stock prices, IT, pharmaceuticals. What's your approach towards those two sectors?
Yeah, I think, see, what happens is quite a lot of these, they cover forward. So therefore, while the sentiment may ensure that they go up a bit, but it is not as if they have huge pricing power and they will be able to retain all the depreciation benefits. So in the next negotiation, I think they will have to give up some of these benefits that they get out of depreciation. But on the whole, I think it is positive for the exporters. I think importers would have covered forward, and that is probably one of the reasons why the rupee has depreciated so much.
And also the point is, when you have such a sharp depreciation, you already have when companies have hedging policies in place. You actually tend to, it's a windfall when you're unhedged, not when you're hedged.
Yes.
Right? There will be, over time, if this stays, translation gains. That always happens, but it is not as if this quarter suddenly everybody is going to post big numbers on the forex side.
Not at all, because everybody covers forward. No company takes these risks on its books, beyond a certain small limit.
What's your view though on the market, Mr. Bhatt? 11,500. What's your sense?
Yeah, I think the market is probably headed downwards. It may not be a dramatic fall, but I think it'll head downwards, largely because of international events. You have problems in the US in terms of interest rate hikes, potential interest rate hikes. You have problems in Iran and Middle East and tariff wars. All these will sort of ensure that the emerging markets are not exactly the favorites. Even though among emerging markets, India may be a better place, but still emerging markets themselves might not be great favorites for the investors. In India, if you really see, we are getting into the state election season now, so that will add one more dimension of uncertainty. So therefore, I think the market cannot really sort of sustain these levels, which are sort of reasonably expensive valuations. And I think there's a correction in the offering for sure.
You're saying rupee will stabilize? Because the RBI is standing between the rupee and the because it's got a big war chest of dollars. but stock markets will fall. The reasons are similar. I mean, what affects the equities affects stocks as well.
No, not really, because the fact is that as far as the market is concerned, market is at historic highs, or near historic highs, whereas rupee has already depreciated 13%, and it is somewhere near REER. So therefore, if you see historically, RBI has played a role when the rupee comes somewhere near REER. It doesn't overshoot dramatically from there.
So how are you approaching stocks which are affected by a weaker rupee, higher Brent crude prices, say the aviation stocks and, OMCs and the entire oil space?
The market has already taken a view on these. I mean, they are at rock bottom prices, as it were. So the issue with the aviation stock is that they really don't have pricing power. There's so much of competition. They don't have pricing power. They're not able to pass on all these oil price hikes. So therefore, they are not in a great place to be. And I mean, this is not the place where one should be invested.
So which are the sectors that you're buying right now?
See, the sectors continue to be the same old favorites, the domestically consumer-oriented sectors, whether it is sort of to some extent autos, to some extent non-PSU bank financials, industrials, because I think industrial activity is picking up. I mean, these are the sectors where one needs to be if one has to be in equities. If you see a correction, a reasonable size correction in the offing, there's no reason for everybody to be in equities unless you're a mutual fund manager who has taken money for investing in equities, then you have to be. But otherwise, as an individual, you don't need to be in equities at these levels, I think.
Okay. All right, Mr. Bhatt, we're going to leave it on that note. Thanks very much for joining in and giving us all of your views. So that's the view coming in from Dalton Capital. We need to take a break with the news that the Nifty is at 11,500. We have the mid-cap index and Bank Nifty both down, but off the day's low. Let's focus on the rupee depreciation. In fact, it's pulled back a little bit, 72.44, but still around a 1% depreciation that you can see on your screen. We have David B of Deutsche Bank Asia Pacific joining in on the show to discuss this and more. David, hi. Thank you very much for taking the time out. You join us at a very opportune time here. We have the rupee, which is depreciated 1% today. It's depreciated around 13% year to date as well. What's your view? How are we placed in terms of the rupee, and where do you see levels go from here on?
Well, I think it's really a matter of what we think about the broader EM contagion. And look, at the end of the day, if that is going to continue, then we still see the rupee as vulnerable. But I think we need to put it in perspective. This pales in comparison to what's happened in Turkey and Argentina. And, I think we can lose sight of that. We can also lose sight of the fact that on the sidelines, in terms of the investor interest we see, particularly from the global real money community, that once we do see this EM contagion subside, and whatever the trigger for that is going to be, there is a lot of interest, particularly across fixed income, particularly across equity, to come into this market. And I think we do need to be cognizant of the fact that at some point in time, there is going to be as I say, once things settle down and the EM contagion stops, we have a wall of investor interest to come into this market. We're continuing from our Deutsche Mumbai business, we're continuing to onshore offshore investors at a fast rate, and really just waiting for the opportune time to come in. So, as I say, I think we need to keep this contagion, the weakness we're currently seeing, in perspective.
David, hi, morning. How much of this is a story of, asking the question, who's next in emerging markets in terms of who gets picked out for some bashing, emerging market forex especially, I mean the weaker ones, vulnerable ones, current account deficit countries, etc. And how much of this is the story of dollar strength? Money is heading back. I mean, you look at US stocks, treasuries, dollar, US assets are being bid up. I mean, isn't that the big story here?
No, that's a good point, Prashant. And again, the dollar strength has had a big influence here. Look, I think the things we're looking at here and watching closely in terms of where to from here, if you like, in terms of EM Asia FX. First of all, I would talk about the redemption risk, and we're watching that redemption profile closely. Half of the global bond index, EM bond index depreciation happened in August, and I think that a lot of investors have probably not yet looked at how their asset allocation is going to go. Again, we need to watch that closely. I think the escalations, again, in the China-US trade wars, again, is important. what also tends to happen in times of stress, and we've seen it in 2015 and 2013, is the increase in hedging requirements that come out of the woodwork. They could be corporate hedges in terms of offshore liabilities. It could be all those fund managers who traditionally don't hedge. And I think, again, that's something we have started to see in other countries in the region, and not so much in India, but in other countries, and I think we need to keep a close eye on that. Clearly, the speed at which the Fed moves in terms of whether there is any acceleration in the speed of rate hikes is important. The current gradual hikes that have been priced in shouldn't have too much of an impact. As I say, I think the real impact would come if we saw an acceleration of that. And finally, as we've talked about many times, oil and metals. And I think that much of the drawdown we've seen in EM year to date has been a function of the higher oil price and lower metals. Again, the big question is what will turn this around? And getting back to the rupee's point, that will be the point we see when that happens, we see these inflows come in, which should be substantial.
David, your point is taken that the rupee has to be seen in context of what's happened to other currencies, say this year as well as in the past 5 years. We're resilient, there's no doubt about that. But in terms of the current macro situation that we're facing, our trade deficit has spiked to levels of around 17 billion to 18 billion on a monthly run rate again. In that context, what is the macro risk that you see in India, and what are you advising your investors?
Yeah, so the current account is still a challenge, but I think that, there's a trade-off for that, particularly from a fixed income standpoint. I mean, at these sorts of yields, and a lot of these savings pools around the world, particularly across European investors, are getting paid zero. And at the end of the day, the credibility that has been built up over the structural reforms here over the last 5 years has created a lot of credibility through offshore investors. And so putting aside the difficulties or the challenges from a current account deficit perspective, we still feel that, as I say, the investor interest is there. What is probably more, not concerning, but creating caution, we have state elections at the end of the month, we have general elections next year. Perhaps we need to get through those to see, the real flows come in. But, in the very short term, we can still see, if things do stabilise, that those flows to come in. So, at the end of the day, the macro here, in terms of, as you point out, the imports still rising, the fact that we're not seeing the necessary FDI in terms of flows at present, that can happen and that can come back. So, as I say, we remain more longer term anyway, very constructive on India. We're going through a period of contagion in foreign exchange. If you look at bond markets, they've actually been relatively well behaved. And as I say, once we do see this stabilise, the currency stabilise, that should give confidence to investors to come in.
Okay. Just before we let you go then, David, can you just list out what your pecking order would be within, say, emerging markets, and where exactly does India fit in? I know it's one of your top bets, but in context to or in relation to other countries.
Certainly. Well, at the moment we are seeing probably the one country in the region which is doing better, and we remain quite constructive on, is Thailand. Again, we are seeing that they have the surpluses, the reserve buffers, and investors are buying, particularly in the fixed income space, into Thailand. So that's one area where we are seeing interest. We're slightly, in terms of being less bearish on countries in the region, is Malaysia. Again, oil's helping there, but again, we're starting to see investor interest come back into Malaysia after the political uncertainties there. Elsewhere in the region at the moment, we are being impacted by this uncertainty. That's obviously been Indonesia and the Philippines, but all of those three countries, in particular Indonesia and India, again, we have that sort of sideline interest to invest, and I think that those two countries remain priorities. China is actually one which, again, has seen more inflows into fixed income, and we remain more constructive there. I mean, clearly a lot has to do with what happens with the China-US trade negotiations. That is one unknown that may prevent us to see more immediate flows come in, but you know, clearly China is somewhere where it is a very under-owned bond market, 2% of foreign ownership. We can see that changing a lot over the next few years. So China is one we, again, on a more medium-term basis, we are quite constructive on.
Okay. Losses now as we speak. So the Nifty is at the low point of the day. It's lost around 100 points. We have the Bank Nifty also, which is lost close to 300 points as we speak. In terms of key losers, it's easier to talk about the winners. There are only 10 gainers on the Nifty right now, and that includes these export-oriented stocks. So HCL Tech, which is up around 1.5%. Following that is Lupin, which is up around 1.4%. And on the downside, and in fact, we do have the rupee, which is hit 72.5. The low point of the day, I think, was 4647, and now it's reached 72.5 already in today's trading session. Remember, the rupee already opened at a record low of 72.17 today. It had closed at around 71.5, 71.4 thereabout, and it had already opened at a record low. So you can see that there's been a continuous depreciation which has taken place on an intraday basis for the dollar rupee. Yes, there is weakness in the Asian markets, there is weakness in Asian currencies such as the Indonesian rupiah, but like you can see, in terms of the depreciation, it's been quite rapid and swift for us, and it's just 12 noon. The rupee, in fact, is open for another 5 hours in terms of trading. We're going to do one thing. We'll have to wrap up on trading hour. I think we can take a break now. And what we'll do is we will come back with more coverage on the rupee. So stay tuned unless we have somebody now to talk on the rupee.